we all hear all the time that Ethiopia is slow when it comes to taking action on the African Continental Free Trade Agreement and the execution and implementation of it. But I'll tell you what, a lot of the things that we've been doing has been slow. We could not be talking about like liberalization a few years back, not long ago. And the discussion has always been very much like within closed doors, so to say. And then lately, it started off with a cautious and a cautiously optimistic tone. And from there on, it evolved into more of a thoughtful and deliberate discussion. So with that, our position into implementing execution would be also happening soon. And when it happens, it's going to be happening fairly quickly and then fast. Question becomes, are we ready? And what are the things that we need to put in place? Yes, we've opened up some of the sectors. Financial sector has been opening up. Liberalization is underway. And that are the key ingredients to regional integration. If we are doing it right, we would come out as the most successful economy that has implemented it. Reason being is Ethiopia is a large country, a GDP in excess of 100 billion US dollars, a large population, 150 million, close to 120 million, a large land mass of varying climate and terrain, has all the ingredients to succeed. And with the integration, it means more success. Now with that, I would like to invite our next presenter, Richard Ketley from Genesis Analytics. He is Director of Financial Service Strategy. I'd like him to invite him over to come and take a stage and introduce himself properly, and then please welcome him, please. Where is the clapping? We did not forget about clapping yet, right? 1,500. We've been counting that. Thank you, Richard.
Thank you very much. Good morning, everyone. Very nice to be addressing you again. I think I first attended this conference about 4 years ago, and the amount of changes we've seen in this market is truly astounding. And not just in terms of what we have achieved, because a lot is yet to be achieved, but the nature of the conversation, the dialogue. The first time I addressed you, there was a furious debate as to whether Ethiopia needed a capital markets. Now we have a capital markets authority. We are about to issue licenses, and the entire conversation has changed profoundly. So I'd like to talk a little bit this morning about how things are looking as we stand today, some of the challenges, and also how many of the institutions represented here today should start to think about the changes that are ahead of them. I think we should have some slides coming up at some point. So you know who I am. Now we just need to get to some of the slides. So I was asked to talk a little bit about financial sector liberalization and digital disruption. And I think what's really important is that these two things are happening at the same time. Most of the economies that you read about who've liberalized their financial sector did so in a very different environment to the one that exists in Ethiopia today and in the world today. So we are liberalizing at the same time that the world around us is transforming very, very dramatically. And this transformation is not something that's happening over there in America and Europe. It's happening here in Africa and in Ethiopia. And at the same time, we're doing this in a situation which is very far from ideal from a macroeconomic perspective. So all of you who are involved in trying to navigate this transition are facing almost unbelievable complexity and challenges. And I salute all of you for what you're trying to do and what you will achieve over the next 3 or 4 years. So I want to cover 3 topics today. The current landscape in banking, and talk a little bit about insurance, because the insurance sector is very, very important, and we tend to speak a lot more about banking than we do about insurance. What it takes to succeed in a liberalized market, and how do you plan for what we've called the mobile disruption. So the first thing to understand is just the situation in the banking sector in Ethiopia. And what stands out in Ethiopia compared to any other market in Africa is the huge size of the public sector banks. You've got, on the one hand, the enormous public sector bank, Commercial Bank of Ethiopia, which is one of the biggest banks in Africa, even though the financial sector is not one of the biggest financial sectors in Africa. And then this huge cluster of 20, I think we've got 23 or 24 private sector banks competing for what's left of the market. So you've got this completely bifurcated market, which makes things very difficult for all of the banks. You at the same time have the introduction of new specialist banks, the Islamic Sharia compliant banks, and then special purpose banks in the mortgage space. So you've got a very complex structure in the financial sector. And at the same time, you've got these other forces coming in. You've got the entry of foreign banks, which are obviously going to try and compete, probably by acquiring some of the private sector banks. You've got a big increase in the number of banks. We've got on the slide here many more banks applying for registration and for licensing. You've got a lot of disruption coming from non-banks, and we'll talk about that a little further. But His Excellency the Governor spoke about the number of mobile banking clients that we see in the market at the moment. And then you've got the increase in capital requirements. And what an increase in capital requirements does is it forces consolidation in the sector, but it also ends up with a lot of excess capital chasing the same credit opportunities in the market. And there's quite a lot that is known from other markets that have gone through this, that on the one hand, you have consolidation, on the other hand, you've run the risk of a deterioration in credit quality in the market. And this is something that all the bank managers need to be very careful about. If we look at the insurance sector in Ethiopia, what is extraordinary is just how underdeveloped the insurance sector is even by African standards. Now, insurance markets in most African economies outside of South Africa are very small, but yours is absolutely tiny. So the growth and the need for transformation of the sector, if it's to play the important role it plays, is really profound. And I think we need to have a very clear discussion of the roadmap. What needs to happen for the insurance sector to grow? And in most African markets, we've seen two really fundamental issues emerging. One is the credibility of regulation. If I pay an insurance premium, will that company be there and honor my claim in a way that doesn't result in me losing faith in the industry? And that's the job of the regulator, to make sure that the insurance sector has integrity. If we look at the numbers of Nigeria, an economy which is the same size as South Africa, you can see there's virtually no insurance sector there at all. Why? Because the sector has zero credibility. The regulator has not managed to convince the would-be purchasers of insurance products that their claims will be honored and that this is the right way to manage the risks that we all face in life. South Africa stands out as having a larger insurance sector than many developed countries. And this is the result of both highly credible regulation, a different structure of employment, but also a very well-designed tax regime that encourages people to make the right insurance product. So for the insurance sector to grow, we have to get a combination of the right investments from the private sector, the right investments in consumer education, and creating the right regulatory framework that convinces people of the credibility of the sector and that buying an insurance product is the way to manage risk as opposed to relying on communities and other means of managing risk. So a lot of work to be done, and I look forward to seeing how quickly this graph changes over the next 5 years. When we speak about difficult operating conditions in the sector, we've spoken about the competitive circumstances, but there are also a lot of other headwinds that anyone looking to invest in the sector has to face and anyone operating in the sector has to face. And these are situations, there's always this chicken and egg with liberalization. Do you sort the macro and then liberalize, or do you liberalize and deal with the macro at the same time? I think most countries don't have that choice. They end up doing both at the same time. But it does make things extremely difficult. So on the one hand, you've got very low market penetration. And this is the result of income levels, and it's also a result of people's familiarity with products. So how do we grow the demand for financial products and do so in a manner that's sustainable? Secondly, we all know the foreign exchange policy challenges in Ethiopia, and this is a situation which makes running any financial institution or any business extremely complex. And so clearly, before the liberalization and the growth of the sector can really take off, the foreign exchange policy needs to be addressed and the exchange rate regime liberalized. I'm sure you've been following the news from Nigeria over the last couple of years, or the last couple of days, after an extremely distorted exchange rate environment. This has now been swept away. The Naira was devalued by almost 30% yesterday, and hopefully this will now start to unravel a lot of the distortions that developed in that market. We also have a very underdeveloped technological environment in Ethiopia today. When I was first, I think it was 2016, I first came to just this conference, I couldn't use WhatsApp in Ethiopia. Now, technology's advanced beyond any of our possible conceptions and how fast technology could advance. At the same time, trying to draw cash this morning, I had to visit 4 ATMs because none of them were working. So we have a long way to go in terms of technology. And the challenge, obviously, is that as technology changes globally, making the right decisions and choices around technology is extremely difficult. Will the investment I make today in ATMs be redundant, 3 years from now? What we've seen in Kenya was that the ATM market has essentially been replaced by agency banking. The number of ATMs in Kenya is now shrinking, even though the number of ATMs in Kenya is far lower than most developed countries. And what we're seeing globally is the ATM market contracting, not because of agency banking, which is still about cash in or cash out, but as a result of the migration to digital transactions at point of sale. If you travel to the UK today, you can probably travel for 2 or 3 weeks and never need to touch cash at all. So trying to make the right technology decisions in a rapidly digitizing environment is extremely complex. I've already mentioned this issue of the extremely high levels of competition between the private banks. We have both the existing, the first, second, and third generation of private banks. We also now have the emergence of regional banks as well as special purpose banks, which is fragmenting the customer bases. And so clearly, a situation of what I would call excess competition, which is creating many challenges in an environment where you may need to make lots of operating investments in an environment of weak profitability and distorted foreign exchange markets. The regulatory environment, regulations globally in the banking sector are reasonably standard. However, in Ethiopia, you do have a number of very specialist or specialized or specific regulations that divert from the international best practices of the Basel standards, and that also complicates the balance sheet management challenges that the banks face. And then, obviously, we're aware of the political instability that Ethiopia has gone through over the last 2 or 3 years and what this does to foreign perceptions of the market and the willingness to invest. So overall, I think the banks in this room all face extremely complex operating conditions, a highly distorted market, and a market in which we may not see quite as much foreign investment as we'd like until some of these macroeconomic distortions are addressed and eliminated. The bigger challenge, however, is not the entry of foreign banks, but the very rapid growth of mobile money provided by non-banks. On the slide, you've got some of the stats from Ethiopia, and you can see that we've got both a very rapid adoption of mobile payments of products that are offered by the banking sector, but we also have the very rapid growth of products offered by non-banks, Ethio Telecom and now Safaricom in the market, and new entrants such as M-Pesa coming into the market. I think I've said this before, you've heard it from me many times. M-Pesa in Kenya earns more in transactional fees than the entire banking sector. It earns double what the banks earn in terms of transactional fees and has a virtual monopoly on the transacting environment. There is not a person in Kenya who I cannot pay with M-Pesa, be it a merchant, an individual, a relative, someone on the other side of the country. And that model is rapidly being replicated in many other markets in Africa. That's not to say Ethiopia will be the same, but the growth of the non-bank digital payment providers is a very real phenomena across most African markets, and again represents a significant challenge to the banks. Should you compete? How should you compete? Should you abandon low-income financial inclusion markets to the mobile network operators, or should you try and compete? What do you do with your legacy branch networks? Is there still a role for branch networks? These are all very difficult questions to answer. And we've also got some data there in terms of mobile phone ownership and smartphone ownership. These numbers are normally kind of a year behind where they should be, so I'm sure those numbers are probably too conservative. And I think you all know how well adoption of mobile telephony is going in Ethiopia. Just to talk a little bit more about the M-Pesa ecosystem that has developed in Kenya and is again growing in other markets. So it starts at the bottom of the circle with the provision of essentially cash in, cash out services, where you can send money to someone, they can go to an agent, take money in or out of their mobile wallets. Then it very quickly starts growing to provide other services. So instead of buying airtime, people buy M-Pesa, and then they keep a balance on their M-Pesa account and top that up using they buy their airtime from their M-Pesa account. So the money stays in the M-Pesa account, they then buy airtime. From that, it starts to pay merchants. So what starts off as a person-to-person becomes a person-to-merchant. And in Ethiopia, as many other African markets, the difference between a merchant and a person, when we've got many tiny, tiny merchants, is not that great. And then what happened in Kenya is they changed the economics. So when I pay a person, I pay the fee as the sender. When I pay a merchant, the merchant pays the fee. This gives everyone an incentive to make a merchant payment using M-Pesa. And so the ecosystem grows. We then find people using it for bill payments. There's a major drive to enable people to pay for all their public utilities using the M-Pesa platform. We then move into savings and credit products. And people can offer savings products where you earn interest and credit products where you can borrow, again, off the M-Pesa platform. These are normally offered in partnership with banks, and the balance sheet of the bank is in question, is brought into play. Then we move into insurance policies. Obviously, one of the major challenges in the insurance sector is the difficulty of collecting premiums cheaply and efficiently, and disbursements. This can be done very effectively on a platform such as the M-Pesa platform. And so we see the insurance market beginning to grow. And then you even get the ability to grow, to invest in public securities on the M-Pesa platform. So you can buy treasury bills on the M-Pesa platform. And then moving into the remittance space. Now, if you want to send money to anyone in Kenya, chances are your remittance provider will give you the option to pay out into an M-Pesa account. And obviously, if your remittance is coming into the M-Pesa account, that money doesn't even touch the bank. It goes into this ecosystem. And so this circle of growing ecosystem around mobile payments is, as I say, well established now in most African economies that are similar to Ethiopia, and basically excludes the banking sector from the financial inclusion market in many ways. So a very important process to watch and understand and figure out how to play in the market. So if we just look at some of the kind of issues, you can succeed, but you need to make some very careful strategic choices. You need to figure out what is your competitive advantage. You need to figure out what channel innovations to support and what channel investments to continue to make, and which channel investments to change. You need to figure out how do you engage with the fintech world. Many of those products that are part of the M-Pesa ecosystem are provided not by banks but by fintechs. But behind every fintech, there's a banking partner. Fintechs typically don't have balance sheets, so they need banking partners. So this is an important part of your strategy. And how do you recognize that the role that digitization plays in improving the conversation you have with your customers? And then finally, every financial institution needs to have a very clear M&A strategy. Are you going to merge with a foreign bank? Are you going to merge with a local bank? Are you going to buy a fintech? Are you going to partner with a fintech? So you need to have all of these as part of your framework. The way we at Genesis help our clients think through these decisions is to use this quite well-known framework, which is called the Playing to Win framework. You can buy the book online easily enough. And what we think is the way to think about this is to try and be very clear as to what is your winning aspiration? What is it that you as an institution want to achieve? The danger of a banking license is it allows you to do anything, right? You can be an investment bank, a wholesale bank, a corporate bank, a retail bank. But doing all of those things, you're not likely to do them all well. So try and figure out what really matters to you as an organization. What do your shareholders stand for? What does your brand stand for? Why are your customers with you? So what is your winning aspiration is a very good place to start. And from then to move into a very careful decision is where will you play? Which segments, what sectors will you focus on? And once you've got that sorted out, how do you figure out how you will win in those sectors? Who do you compete with in the sectors and in the spaces in which you wish to compete? And from there, you can start having the right conversations about what capabilities need to be in place. And if you follow this, what we call the strategy waterfall, chances are you'll make some better decisions when you get to the bottom of this waterfall, rather than trying to make decisions around branches or products too high up in the decision tree. So I think that's it from my side. Any more? I think, yeah, you've been waving at me, telling to shut up. So thank you very much.